Welcome to the latest Royal London Global Equities video. It's been a remarkable few months in markets, with sharp downdrafts in March and April as the virus took hold and lockdowns ensued around the world, damaging economies. Though we've seen a sharp rebound in April and May as optimism about the control of the virus, vaccines coming through, and lockdowns ending in many countries have come through. But what we think has really driven returns is the discount rate, and that's closely linked to central bank policy. We've seen a remarkable opening up of monetary policy from central banks around the world that's unprecedented, even relative to the global financial crisis. That's also been combined with government stimulus in many countries that's helped maintain personal incomes and drive spending. To understand the impact of the discount rate on valuations, we use our pricing puzzle, which we've been using for many years. What this looks at is the aggregate profits and cash flow that companies can generate and relates those to the current market levels to solve for the discount rate. We can plot this through time to give us some idea of what future expected equity returns are going to be. It also helps as a concept for what is the risk appetite that investors are prepared to accept in equity markets. Investing is a relative game, and so of course that will take into consideration the returns that are available in bond markets. These are incredibly low at the moment, and of course, in most cases, don't provide any inflation protection, unlike equity markets where there's some pricing power for companies. We think that this factor is what's really driven the rebound in equity markets. Cash flows are going to be lower, but investors are prepared to take that extra risk because of the market environment we're in and central bank policy. Our life cycle concept is very helpful for us in deploying capital and conceptualizing investments in this environment and really enhances our insights. So at the front of the life cycle, in the accelerator category, these are disruptive businesses that are growing strongly. Many of these have seen an improvement in their opportunity set because of the virus environment and the impact of governments. So, for example, businesses like Amazon that was already expanding capacity has been able to take advantage of this environment that we've been in. Ocado is another one in the UK. And really these are disrupting and continue to grow quickly through this environment and can take advantage. And so that's a great opportunity for them to continue to expand at the expense of other businesses. In the middle of the life cycle, compounders are businesses with high returns that are established. And as a compounder, the right way to create wealth is to be able to invest back into the business at a similarly high rate of return. A lot of compounders have a high rate of return, but can't reinvest back into the business. They don't have that opportunity set. Where we can identify compounders that can reinvest, that's incredibly valuable. And it's much more valuable in these times of low returns. So the fact that other businesses are accepting low returns, and there are low returns in the bond market and in the cash market, the ability to recycle that cash back into the business is incredibly powerful and rare. And so we're taking advantage of that in businesses where we can identify that opportunity set. At the end of the life cycle in mature businesses, these businesses have low returns and they need to focus on trying to maintain those returns and generate cash. It's a difficult environment for many of these businesses, but ones that we think have a competitive advantage and importantly at the moment, a good balance sheet can still generate good investment opportunities. We know there's a recession coming, and so we're focused on businesses in this segment that can ride through the downturn because of the strength of that balance sheet and generate cash on the other side, if not through the downturn. And so that still provides an opportunity set. Importantly, in that stage of the life cycle, there are still great valuation opportunities. And the payoffs there are frequently more attractive than the well-discovered opportunities at the front of the life cycle in the accelerating and the compounding stages. So we are taking advantage of some of those valuation payoffs that are attractive at the end of the life cycle. Currency has been an interesting factor for UK investors through this crisis. At times of crisis, investors tend to flock to safe haven currencies like the US dollar or Swiss franc. Most of the capital invested in global equity funds is in the US and overseas markets, with relatively little being invested in the UK. So this weakness in sterling has actually benefited UK investors, because as those foreign currency returns are translated back into sterling for investors, that has helped lift returns from global equities for sterling investors. We typically see this in times of crisis, and it has played out this time again. In terms of our outlook for the equity markets, really we believe that central bank policy will remain accommodative, and so that will underpin equity market returns. While equity market returns look slightly expensive relative to history, they do remain very cheap relative to the returns available in the bond market. In terms of what we're doing, we've used our insights from our investment process through the crisis to be able to reallocate capital and take advantage of some of the volatility. And we've tilted the portfolio and used that to our advantage.